Good morning, guys. It is Wednesday, February 21st, 2024. This is Bathrobe Business. I am not in my bathrobe and I am not in my office. I am at work and I do not have my coffee today. I have my Monster and I have the news. So I did want to get a video out today, even though I had a late start, because I'm not going to have a video tomorrow or Friday. And then potentially I might miss the video on Monday. It depends on when my flight gets back because I'm taking a trip this weekend. But there's a number of stories I did want to cover and some pretty major ones that I think are kind of sleepers that nobody's talking about. The first one I'm going to talk about is political. So normally I try to stay away from the political stories, but in this scenario I'm going to cover it because I think it greatly affects the economy. I also don't like politics because people are too teams oriented. So if you love Biden, everything he does is amazing. If you hate Biden, everything he does is amazing. And vice versa, same for Trump. But I try to analyze these things with no bias, just looking at the data itself. So first story is student debt. So Biden is going to forgive $1.2 billion in student debt. So roughly 150,000 borrowers. So the relief will go to borrowers who have been in a repayment for decade or longer. So if you've been paying on your student loans for about a decade, and if you originally had an amount of $12,000 or less, then your debt will be forgiven. Also, you don't need to do anything because you should have a link just in your email. That seems very weird to me because I don't use the same email I used in college. So I don't know how they would contact me in that scenario, because in my example, I did take out less than $12,000 in debt, and I have been paying for longer than a decade. So that's, I think, also just part of the caveat of how they're going to try to weasel out of this. I don't think this can be taken as any way other than a political move because of the election year. The same thing happened the last time around. So in the midterms, that's when the talk started about debt forgiveness. And here we're in an election year again, they're talking about debt forgiveness as well. I also think that if you were to look at the metadata here, I think a lot of this is very political. It's not a surprise that it is only affecting 150,000 borrowers, that it's only affecting a specific group of people who have paid for a decade or longer, and that it's $12,000 or less. I bet if you correlate that data, you'll find that those people are among those that would not vote for Biden, but that this information, given the fact that their loans are forgiven, could sway them to vote for Biden. So in other words, they probably ran meta-analysis, AI analysis on individuals of who can we swing in certain states in order to get a bump in voting. Because remember, it's only 150,000 people, but with the Electoral College, you only need 150,000 to win. You can win with less. You can technically lose the popular vote. It's happened multiple times, but still win the Electoral College and therefore win the presidency. So 150,000 borrowers could be the difference between presidency and no presidency at all. So I think this is a very tactical move. I bet this was run with heavy data, especially now in the age of AI. I bet they did heavy data analysis and determined that this amount, this term, these group of people are going to be the ones that are best going to be swayed into voting for Biden by doing this maneuver. We'll see if that pans out. The other thing I'm going to talk about, this is kind of deviating from politics, but again into the economy, is U.S. cybersecurity. So Biden just signed an executive order on all U.S. ports, cybersecurity, and infrastructure. This is a pretty big move. This is going to mean a couple of things. So it's a pretty broad sweeping regulation. So it's going to affect cybersecurity at all major ports in the United States. It's going to affect customs. It's going to affect infrastructure and a lot of the logistics that play into incoming shipments. But one of the biggest things it's going to affect is even cranes. Now, why I underscore this, this isn't, with a cybersecurity bill, you think this would be all based off of software, but it's actually not. It's based also on hardware. So they're trying to essentially move in a direction where they are getting rid of Chinese cranes entirely. This is a protectionist move. And 80% of the cranes used in ports are Chinese built. So by doing this, they're essentially trying to eliminate Chinese infrastructure completely from U.S. ports. This is very similar to the Jones Act, which was passed probably over a century ago, if not more, where all ships entering U.S. ports have to be built within the United States, which causes, honestly, a lot of congestion and a lot of excess cost in the system. And I think this is going to do the same. I think this is going to be a very powerful inflationary pressure. And the other thing it does is it's going to shift pressure from ports to free trade within the United States, North America, South America. So in other words, I think this is a bill, or I should say an act, that is going to strengthen relations between the U.S. and Mexico and weaken them between the U.S. and China. So we reported a couple weeks ago, if you remember, that for the first time in history, imports from Mexico outpaced imports from China. So this is going to be another push, because now that means that shipments coming in through ports are going to be more expensive because they have excess infrastructure, excess regulations behind them. So you're more likely to use rail and car to transport things from Mexico to the United States. Now, nothing doesn't say that those ships can't port somewhere in Latin America, South America, and then get transported up. As we reported, Brazil has a massive port that they have built with China's money and infrastructure through the Belt and Road Initiative. In addition, Venezuela, Argentina, they all have strong relationships with China. So these ships can be ported in a lot of different places and then just transported up into the U.S. But I still think this is a major push to be anti-globalist and anti-China. In other anti-China data, or I should say anti-globalist information, so the first time at the World Trade Organization, there is debate about getting rid of the moratorium on e-commerce tariffs. So this is a little bit of a deceiving story, but what it essentially means is right now you can use Google, you can use any data-driven company like Spotify. Let's say you're listening to Spotify. Spotify is technically a foreign company, right? You're streaming from, I believe they're based in Sweden. So you're not paying any tariff or any tax on that. The data you're downloading or streaming is tariff-free. There's chatter that could change. And if that changes, that would be a major, major shift. And it could affect a lot of the tech industry, because so much of the tech industry is actually based in foreign markets. A lot of people hire programmers outside of the United States, use companies outside of the United States, and that data and that e-commerce, that IP, all moves across the world with no tariffs. If this chatter continues and that changes, there could be tariffs on IP and on e-commerce. So that, sorry, I'm losing my voice. So that is kind of a major story in regards to global trade. I think that's going to be pretty massive. If that does move forward, that would be a groundbreaking shift in how the world economy works. I think it would be like a ADBC kind of scenario where there would be before tariffs and after tariff structures. It would greatly change the infrastructure of the entire world. Needed my monster. Next story I'm going to cover is mortgages. So mortgage demand has taken a massive hit because interest rates are not going to be cut. The average cost of a 30-year mortgage is over 7%. It was at 6.8% last time I reported. 6.87%. Now it is 7.06. So it's up almost a quarter of a percentage point. And applications for refis have dropped around 11%. Now, before we say it's all doom and gloom, need I remind you why I like high interest rates. Private equity payouts at major firms have plummeted 49% in the last 2 years, exactly coinciding with a raise in interest rates. So it's almost as if when you don't have free, cheap money, you can't go in and bully the market and acquire companies at massive scale and then be able to consolidate, outsource, and downsize everything. You actually have to put work in because you have to actually get a return on your investment. So it's almost as if these companies have to function in a normal market. As you know, I am very anti-private equity. I'm anti-everything big business, anti-hedge fund, venture capital. I think a lot of these firms operate on imaginary monopoly money, and high interest rates are finally putting the squeeze on them, which I think is absolutely necessary for a functioning economy. It's not a coincidence that in decades since interest rates went low, American consumers have suffered the most and these companies have gained the most. So putting pressure on them with high interest rates is evening the playing field, and it should continue and needs to continue. That's pretty much it. So that's my last post for the week. I will see you guys next week, and I hope you have a productive day and a productive week. Take care.